Okay, I think we can start. Good morning and welcome everyone to this webinar where we are presenting the first edition of the ACER LNG Market Monitoring Report. And my name is Joaquin Garcia and I work in ACER Gas Market team. So as you can see in this next slide in the agenda, for today we plan a 1 hour event. We will start with some introductory remarks by our ACER's director, Mr. Christian Stingersen, and then we will have the first session where we'll be summarizing the report's key findings. Right after, Alex Flory from ACER will shortly update us on the latest LNG market developments in 2024. Later on, we are having a panel discussion about how navigating the current and future challenges that the EU LNG market is facing. And to conclude, we will have a Q&A session. Before I give the floor to Christian, I would like to share with you some housekeeping rules. So please first know that the meeting is being recorded, and also please keep your microphones muted. And importantly, as regards the questions, you are invited to please type your questions at any point during this session using this Slido tool within the Microsoft Teams. You can vote the questions through the whole session, and then we will address the most voted questions at the last part of the webinar. So, yeah, without further ado, I think we can move on. And please, Christian, the floor is yours.
Yes, thanks a lot, Joaquin. Let me just check that you can hear me okay. Okay.
Yeah, we can.
Very good. Thanks a lot. No, welcome everyone to this webinar. This is the webinar where we present our very first, our inaugural LNG dedicated volume of our market monitoring report series, which many of you will be familiar with. And we suspect that this will likely be a recurrent feature of our market monitoring report efforts going forward, this select focus on LNG. And the backdrop to that, of course, is that LNG has become and is rapidly becoming part of what we like to refer to as the new supply-demand equilibrium, if you will, of EU gas markets going forward. And that brings with it a number of implications, which we also turn our attention to in this very first LNG dedicated MMR volume. One of those is with that increased significance of LNG that will enhance European exposure to what is in several respects a global commodity market with some of the volatility and cyclical dynamics which often characterizes such markets. It also raises the stakes, so to speak, for governments in terms of being on top of global trade patterns in LNG, but also it raises the stakes in terms of being aware of the, let's say, availability of various volatility mitigating tools and instruments, including long-term contracting, obviously long-term contracting within the context of what we suspect will be overall gas demand decreases, at least over time, given the decarbonization trajectory which the EU has set itself for itself. And in turn, it also increases the focus on access conditions to LNG import facilities and the products offered in that respect. So all those elements we devote some attention to in our LNG volume this time. It's a topic of increasing significance for the European Union, and so we intend to invest more here going forward, building on this very first effort, which we will be presenting to you and discussing with you today. Those would be my introductory remarks. I turn back to Joaquin and Pedro to take us through sort of, let's say, the main headlines of the report, and then we turn to the update from Alex, following by the panel discussion moderated by Chila, our acting head of gas, hydrogen, and retail. Over to you, Joaquin and Pedro.
Thanks a lot, Christian. I will continue and offering an introduction to the report. But first, as Christian was referring, and it was the reason to include this year dedicated LNG report was indeed the enhanced significance of the LNG market for the EU energy system. For those of you that perhaps are more familiar with our market monitoring activities, you know that for 12 years we have been issuing annual gas market monitoring reports. And in these broader gas market monitoring reports, we also were analyzing the LNG market developments, but we decided to go for a more in-depth ad hoc volume because of the significance of LNG in many dimensions. So this is the structure of the report, as you can see in the slide. We are proposing 3 chapters to to offer a comprehensive overview of the LNG market dynamics and how the relevance for the EU market. And we are proposing this so-called 3 chapters. We are starting with an overview of the global energy market dynamics, offering some assessments on supply, prices, demand, both at European and global level. And then we believe that the second chapter is the one that is more core to this report, because here we are focusing on the LNG trade developments and importantly on the LNG contractual position of EU market participants. In doing that analysis, we are leveraging not only public and also private data, but importantly, the information that is reported to ACER for conducting this LNG daily price assessment that you are familiar with, and it has been offering very rich information to assess some information such as the indexation of the contracts or the concentration of trade levels. And then we are offering or proposing a third chapter that we perhaps is more aligned to our ACER remit, and it's more about the regulatory considerations that we also will be discussing in more detail through the panel, and also some considerations about how LNG volumes impact the market functioning or EU level, considerations about LNG setting the marginal prices, competition elements in the gas markets. So this will be my introductory remarks, and then I pass the floor to Pedro, who will guide us through the 2 first chapters. Pedro, whenever you want.
Hello, good morning to everyone. My name is Pedro Céspedes. I work in the ACER Gas, Hydrogen and Retail Department, and I'll start the presentation of the key findings of the LNG Market Monitoring Report with the Global Market Dynamics and LNG Trade section. So, the adoption of the REPowerEU plan after the Russian invasion of Ukraine led to a series of coordinated measures across member states, such as gas demand reductions and supply diversification, with LNG imports being instrumental in replacing Russian gas pipeline supply in record time. Since then, the European Union has been the largest source of incremental demand for LNG, importing 57 BCM more in 2023 compared to 2021. This has driven a significant shift in the global LNG trade. The European Union has emerged as the largest LNG import market globally, ahead of China and Japan, while the United States overcome Australia and Qatar, becoming the largest LNG exporter. A massive expansion of LNG production capacity is underway, led by the United States and followed by Qatar. The recent pause on granting new LNG export licenses in the United States does not have an impact on those US projects which had already taken final investment decision or are currently under construction. So, as we are showing in the next slide, there are currently 19 liquefaction projects under construction, which are projected to increase existing capacity by around 200 million tons by 2030 compared to 2021. Such increase in production capacity is equivalent to half of the LNG volume traded globally last year. Gas demand in the European Union is expected to decline over time this decade, driven by the. There are 2 decarbonization scenarios, Fit for 55 and REPowerEU, with different level of ambition and therefore different impact on gas demand at the EU level. Fit for 55 legislative package targets a decrease of 30% in gas demand by 2030, relative to 2019 levels. While REPowerEU plan builds on Fit for 55 goals and sets more ambitious targets for renewable energy and energy efficiency, meaning that if REPowerEU targets are fully met, the gas demand reduction for 2030 will be 200 BCM less than in 2019. The evolution of EU gas demand will determine the import needs of LNG in the European Union. This is because we expect a relatively stable evolution of domestic production, with renewable gases compensating somehow indigenous production. So a stable domestic production and stable pipeline imports, except from Russia, where the target is, according to REPowerEU, is moving completely away from the reliance on Russian fossil fuels by 2027. So LNG is expected to be the source of flexibility in terms of gas supply that meets the declining EU gas demand. So as we are showing in the next slide, once the LNG needs are identified according to the two decarbonization scenarios, we wanted to find out what the reliance on the spot market would be in these two cases. For that, we have looked into the long-term contracts, which intended destination is the European Union and will be active in this time frame up to 2030 to build up the contracted level. This is represented by the two blue bars, where light blue represents FOB contracts and dark blue represents DES contracts. So the gap between the expected LNG needs and the contracted level is the volume that most likely will be traded on a spot basis, which is represented here by the yellow bar. This is what is also called reliance on the spot market or exposure to the spot market. Reliance on the spot market will be reduced from 49 BCM in 2023 to just 11 BCM in 2026 under REPowerEU scenario, while in the case of Fit for 55 scenario, reliance on the spot market will remain higher, between 50 and 60 BCM. From 2027 to 2030, if REPowerEU targets are met, there will be a complete turnaround where the long-term contracted volumes will exceed the projected LNG needs. That would lead us to an overcontracted position ranging from 30 to 40 BCM of LNG above the expected LNG needs. The contracted surplus is expected to be delivered to other LNG markets outside Europe, and this will be facilitated by the inherent flexibility of the free on-board contractual arrangements. Therefore, flexibility provisions in LNG long-term supply agreements will be crucial to manage the reduction in gas demand targeted by the EU decarbonization goals, especially if overcontracted LNG scenarios materialize. So today's reliance of the EU in the spot LNG market accounted for 49 BCM out of total LNG imports of 134 BCM. This is 36.5%, which is aligned with the global average of the spot trade versus long term. We have observed a decreasing preference for TTF and other European hubs as indexation terms in long-term contracts in favor of Brent indexation for those supplies sourced from outside the United States. While in the spot and short term, TTF remains as the dominant indexation in Europe, being present in more than 64% of the trades. This is based on the results of the analysis carried out with the indexation terms reported by buyers and sellers under ACER's LNG price assessment for spot and short-term trade with delivery in the European Union for year 2023, which accounted for 47 BCM, 95% of the total spot and short-term LNG market in the European Union, showing the high reliability of ACER's LNG price assessment as benchmark for price discovery and transparency of LNG spot trade in the European Union. So now, for the next section of the presentation of the EU market functioning and regulatory aspect, I will give back the floor to Joaquin. Thank you. You are mute, Joaquin.
Thanks. Thank you, Pedro, for guiding us through the first two chapters of the presentation. And I would like still to conclude with some remarks on some considerations on this third chapter where we analyze the role of LNG in the market functioning. And this first slide somehow discusses what has been the role of the enhanced LNG capacity in alleviating supply congestion and bringing prices to more normal levels. As you can analyze or see in the graph, what we are presenting here is the spread between the prices of the LNG at the cargos at sea and the prices of TTF within the BTP. And as it is well known, these price spreads reach the highest levels in the summer of 2022 in the mid of the Russian supply disruptions and the overall crisis dynamics on the market. Since then, the development and the construction of new liquefaction capacity, regasification capacity has been, as said, instrumental to alleviate congestion. As you can see, there is a correlation between the highest levels of these spreads in the months of August and September, where the capacity was fully utilized, capacity being signaled by the purple line and the utilization of that capacity being signaled by the blue line. But then gradually, as new regasification capacity became operative in Northwest Europe, this is for the graph is the sum of the Netherlands and Germany, and there was more ample available capacity, then the spreads started to decrease. In sum, as known, since mid-2022, regasification capacity in the EU has expanded by 15 BCMs a year. And then I see also there are starting to be some questions in the slide. Is this is too much? There will be over investment or lack of utilization of that. We can also discuss about those aspects in the Q&A session. But overall, this reminder that most of this capacity was developed like floating regasification units that in principle should add more versatility and flexibility to accommodate the evolving supply and demand dynamics. Then I have still one slide about recommendations that, as I said, we will be discussing in more depth with Theodora and Simone in the panel. But overall, our position here is that while the LNG regulatory framework is not in need of radical revisions, also because the different features of the terminals of the systems would make complex to standardize in very detailed manner for the whole of the EU, we still believe through this analysis that certain mechanisms can help safeguarding the more fair access conditions and foster competition. So these mechanisms should be considered like best practices to apply within the system capabilities. And then we are distributing or listing through three blocks. The first one would relate to transparency provisions. And we have to say that transparency is quite advanced or has improved a lot in the last years, also with this ACER LNG transparency platform that we are familiar, and the LSOs publishing more and more information. There are perhaps some buckets of information that would be still important to achieve. For example, those related to the transparency of the access in tariffs, particularly for these negotiated terminals. Something that we are not bringing here, but the report contains is a comparison of the different tariffs of the terminals. And then it will be important that the different market participants have still even more clear transparency about the terminals. Another angle area for that could benefit for enhanced transparency relates to the secondary capacity information. As you know, in the new gas decarbonization package, I think Fedora also will elaborate on that. There is more emphasis on this secondary capacity allocation, also in view that a significant part of the primary capacity has been fully booked. And then, if we are going to leverage those secondary capacities, more transparency will be always appreciated. Then there is a second block for these best practices that we refer to the competition practices. Again, we need to find a balance between promoting competition at terminals and at the same time that the booking of capacity in some occasions by few players was also instrumental to determine or to trigger the investment decisions, and also full bookings of the capacity also provide more stability for the revenue recovery and the tariff stability. But perhaps some, as I say, best practices that we have identified would be not allocating the total access capacity in the first round. This meaning reserving some short-term capacity in order to trigger certain competition. Also, as done in some terminals, limiting the amount of the primary capacity that can be allocated to the dominant players. Also, this will be facilitating competition. And then overall, implementing market-based allocation methods, particularly auctions, and clearly when demand exceeds overcapacity. Then we have a third block of best practices related to flexibility. We label like flexibility. And this refers to, again, a more flexible allocation of the capacity and the products and the managed products can support some competition also at the terminals. And this relates, for example, to when you unbundle the products and you allow market participant to trade the gas in the storage, not bringing the whole cargoes, but accessing only the capacity for the storage and regasification services, they can trigger and invite other market participants, smaller market participants, to trade on the terminals, and also backing that with flexible send-out options. Overall, these competition and flexibility aspects are particularly important in those markets that are less liquid, in the sense that if you don't have competition, full fees competition at the terminal, but the terminal is located in a hub where competition is quite active, a very competitive hub, well, there is not so determining. But if not the market, not the terminal is that competitive, then you could start facing some competition issues. So this is for the report. I stop now for this overview. We can, as I address the questions later on, and I will be passing now the floor to Alex, that will be updating us on the recent market developments in 2024. Thanks a lot, Alex.
Okay, thank you, Joaquin and Pedro, for the update. My name's Alex Froley. I'm an analyst with ICIS, which is an energy and commodity information provider. We're going to be talking about the market has entered a bit of a new phase this year after the difficult couple of years we've just had. And it's a lower price phase. It's a more comfortable market in the recent months, and for the near term at least, which is very welcome, of course, for many consumers. We've seen prices have drifted gradually lower across the winter, October, November, December, continuing to fall in January, February. That's because it's been a mild winter in Europe and elsewhere in the Northern Hemisphere, so that's reduced demand. Also, industrial demand hasn't really picked up too quickly. That's both a positive and a negative. It's good for security of supply, but of course that has implications on productivity and the economy. But overall, that has meant that the market's been fairly comfortable this winter. The TTF price for Europe, the benchmark price, has dropped lower. In dollars per MMBTU, the international unit, we've come down from sort of $15 through $10 below. In euros per megawatt hour, we were up above 50 euros per megawatt hour at the start of winter. We've broken down below 30. In February, the price got down to as low as 23 euros per megawatt hour. So we've had this sliding of prices and comfortable storage levels, record high gas storage for the time of year. And that means that when we come into summer as well, the market is more comfortable because you won't need to inject as much gas over summer to fill up ahead of next winter. We can see on this price graph here, we have the TTF price for Europe in blue. We have our East Asia price for Japan, China, Korea in red. That's following a similar path. Those markets are closely linked as Asia and Europe compete for cargoes. Actually, we've seen Asia has a bit of a premium across this year. So Asia managing to attract a few cargoes away from Europe. That's not a concern because Europe has high storage, so it's not a big concern that a few more cargoes, slightly higher prices attracting them away. The US Henry Hub, of course, we can see very low prices. The Henry Hub has dropped below $2 per MMBTU. And this means there's a continued strong incentive to export lots of cargoes from the US. Good profits between the $2 prices in the US and the 9 or 10 in Europe and Asia. And that's why there's a lot of interest still from people to invest in new projects, in new liquefaction in the US. The oil price, meanwhile, that's now quite a bit higher than the spot gas price. The last couple of years, unusually, the spot price was higher than the oil price. But now the oil price is sort of back to being above the gas price, which has implications for the balance between long-term oil-linked contracts and spot gas prices. Yeah, if we could go to the next slide, please. So what else have we seen? Well, the other big news was the Suez Canal and the Red Sea. Obviously, because of the conflict in the Middle East, the area at the bottom of the Red Sea, the Bab el Mandeb Strait, that became dangerous for shipping to pass. And we saw a slowdown in December, and then from early January onwards, LNG tankers all stopped going through the Red Sea and through the Suez Canal. So normally we have around 30 to 40 laden tankers would go through the Red Sea every month. A similar number of empty tankers returning to load. The main users of the Red Sea Suez Canal route, Qatar, of course, that's for Qatar to send cargoes to Europe. The US was also a big user. The US would send cargoes east through the Mediterranean, then down through the Red Sea to reach Asia. And also Russian cargoes would use this route. These were Russian cargoes from the Arctic Yamal project would come west to Europe, they'd transfer ship, then they'd come back round through the Med, down through the Red Sea and the Suez, and then over to Asia. And after the closure of that shipping route, for a cargo from Qatar to Northwest Europe, that adds around 10 days extra shipping time. To get from Qatar to Italy, even more than 10 days. For a Russian cargo going east to Asia, now that they have to avoid that and go down the long route around Africa, that could add around 7 days. So this is extra time being added onto the shipments. Not so bad for the US cargoes, actually. It only adds 1 or 2 days extra for a US cargo to go down around Africa rather than coming through the Med and through the Suez. So it's not as bad for a US cargo to Japan or China, but extra time for the Qatari and Russian cargoes. But I think the bearish, more comfortable market that we talked about, we can see that in evidence by the fact that when this happened, when the ships started to avoid that route, gas prices didn't jump up. There was no real impact because people felt quite comfortable about the balance of the market for the near term. In fact, also the shipping charter rates, the cost of hiring a ship, those have been sliding as well. You would think if the ships are taking 10 extra days to make their journey, then you'd think the cost of hiring a ship would jump up because ships would be in shorter supply. But the charter rates have been dropping as well. I think the more modern vessels from around sort of $160,000 a day last November to around $45,000 a day currently. We've just seen one cargo through the Suez Canal since January. The Flex Volunteer, I think it was in April, went through the Suez Canal. That was delivered to Jordan, so it only went into the top of the Red Sea, not the bottom. It was a US cargo into Jordan, and then the gas was flown back to Egypt through the pipelines. That flags up another interesting point, actually, which is that Egypt has been a bit of a swing country this year. So Egypt had been exporting increasing amounts of LNG over the last couple of years, but their production has declined a little. They have strong domestic demand. So Egypt seems to be swinging back from an exporter to more of an import market, which has a bit of a tightening effect on the global balance. Yeah, if we could go to the final slide. So what we saw with these, Europe has comfortable storage. That's meant that the spot gas prices have dropped down lower in Europe. Asia's had a bit of a premium, and we've seen that means a bit more LNG in Q1, Jan, Feb, March has shifted from Europe to Asia. Again, not a problem because Europe's fairly comfortable. So we've seen that particularly the South Asian countries, India, Pakistan, Bangladesh, Southeast Asia as well, growing. Thailand is growing quite rapidly recently for power generation. We have some newer countries as well, the Philippines, Vietnam. They've been having some very hot weather recently as well, so they need more power generation. So some of those buyers still quite price sensitive though. If prices go up, if Europe turns into shorter supply, the TTF price will rise and those cargoes could be attracted back quite rapidly from some of those buyers. China, of course, China is the world's biggest LNG importer, and we've been seeing some record demands from China with these slightly lower prices of recent months. China has actually hit new records in February, March, and also in April, the highest ever February, the highest ever March, and the highest ever April. So China is taking advantage and buying some more cargoes. But just finally, although we're a little bit more comfortable now, and Europe could attract those cargoes back if prices go higher, Europe can pull those cargoes back. You know, the market, there is still some tightness to the balance. We've seen with oil prices going up and concerns about the Middle East, obviously there's a lot of uncertainty there. That's actually given a bit of a boost in prices back above 30 euros at times, slightly under 30 this morning, I think. But there's a bit of tightness there. As we look to the next winter, we should go into winter with high storage levels. But there's still a possibility, if it does turn out to be an unusually cold winter, the last 2 winters were mild, but an unusually cold winter could boost demand. If there are any production problems around the world, there can always be unexpected problems, then that could also tighten the market. However, we've seen in the past, we've seen in 2022, that Europe can raise its price to attract cargoes back in the flexible market. So the market mechanisms do kind of work. If the market does turn a little tighter next winter, if it's cold, then the prices will go up and Europe probably can draw more cargoes back for security of supply. So yeah, thank you.
Thanks a lot, Alex, for starting with us these very valuable insights. We are moving now to this panel session where we'll be discussing how to navigate the future challenges. And now I pass the floor to Cila Bartok and the colleagues. Cila, the floor is yours.
Thank you very much, Joaquin. Good morning, everyone. Do you hear me well, Joaquin? Can you confirm that?
Yes, we can.
Excellent. So I have the privilege to introduce our panel composed of Feodora Petit from the European Commission, Simone Antonelli from Shell, and we'll keep Alex Flori from ICES to continue the discussion here in this small group. The panel will be focusing on navigating the challenges of the EU LNG market, and our focus will be to explain the forthcoming challenges, including the regulatory challenges, the competition challenges, and we should be also digging into the market outlook a little bit further. Starting with Feodora, I'm presenting her. Feodora is team leader at DG Energy at the European Commission, and she's dealing with the internal energy market. And the reason why we invited Feodora is that she could give us some additional insight into the regulatory framework. And as we know, the regulatory framework will change as we are going to implement the newly adopted hydrogen and decarbonized gas market package. And the question to Feodora would be, given the growing significance of the LNG in the EU energy market, do you believe that the current, in the sense the changing regulatory framework, will adequately ensure competition and would respond correctly to this change shift that we are more reliant on LNG? And as a follow-up question, maybe you could also reflect if you believe whether we would need any refinements in this area. Feodora, the floor is yours.
Yes, thank you very much for the invitation to this webinar, and I'd be very happy to say a few words about the regulatory context and see in how far it contributes to, let's say, competition, transparency, and in how far we consider it to be adequate. So maybe to start off, let me take one step back and start with some very broad remarks about the regulatory framework. So as such, LNG terminals in Europe are typically subject to regulated third-party access and tariff setting. And so whilst the EU law sets the general principles, it's national authorities who fill in these principles with life to ensure that the access to the terminals is non-discriminatory and transparent. Then there are a few terminals in Europe which benefit from a so-called exemption, and sometimes there is a bit of a misunderstanding around the term exemption. So I just want to spend 1 or 2, well, maybe not minutes, but a little bit of time on that. So an exemption is granted to terminals which are faced with a very risky investment, and this investment would not, let's say, take place without the exemption. This is the logic behind it. These exemptions, they are granted by national authorities, and when granting these exemptions, a very detailed assessment is done on their impact on the market and their impact on competitions. And these exemptions typically contain quite stringent capacity allocation rules that the market parties have access, so they typically have open seasons and auctions. And some of these exempted terminals actually fulfill conditions in the ACER report quite well. They're exempted terminals where it's mandatory to set aside volumes for short-term bookings, caps on dominant players. So basically, to say is that these terminals cannot simply do exempted from third-party access rules and tariff rules, but they are actually subject to quite stringent requirements. Then with regard to transparency, so indeed also highlighted in the ACER report, transparency extremely important to ensure good use of the terminal capacity out there, and it's always beneficial for the market functioning. So when we started reviewing the internal market rules some years now already, some years ago, this was actually one of the main, our main findings is that there could be an improvement in the transparency of the functioning of the LNG market. And so we proposed some rules that were then actually taken up already in 2022 as part of a temporary emergency regulation to contribute to enhanced transparency. Now, what are these rules that I'm talking about? So twofold. One is that LNG terminal operators have to establish a platform either individually or with other LNG terminal operators where there is transparency or the possibility for capacity holders to trade their secondary their capacity on a secondary market. So the first one is trading of secondary capacity on a transparent platform. Then a second one, second important requirement is the setup of an EU-wide platform where there would be an overview of the conditions under which one can use the services of LNG terminals. So we consider that. Yes.
I'm sorry to interrupt you. Can you wrap up? So
yes,
what are then the key elements? Thank you.
So these two elements, the platform on secondary, for the secondary market, the platform on the conditions to use the services of the LNG terminals are, let's say, core elements to enhance the transparency. They are in the hydrogen decarbonized gas markets package, which will be adopted. And in our view, the proper implementation of these provisions will be key to help further improve the market functioning there.
Thank you very much, Feodora, and thank you for these insights about the regulatory framework. I'm turning now to Simone Antonelli from Shell. And here we would like to focus a little bit on the practical aspects. What are the best practices eventually in the market that as a company you Shell eventually were faced with, and then whether there were obstacles that you would like to highlight here. So in order to have maybe a practical understanding about the real life experiences when it comes to LNG terminals. Thank you. Floor is yours.
Thank you. Thank you for inviting me. Do you hear me well? Yes, I guess. So, my name is Simone Antonelli. I'm the head of regulatory affairs for South and East Europe at Shell Trading and Supply. And we at Shell, recently, over the years, have been looking at best practices for further optimization of the usage of LNG facilities. We think that LNG is critical, is a critical source for security of supply, and we think it will help enhance the competitiveness of the energy market. There are two elements that are needed: clear capacity access rules and rules that consent an efficient use of LNG facilities. So the best practices that we have seen that have been implemented in some facilities, we would like to see them implemented more widely. And we were very happy to see and to read in the ACER report that many of these best practices have been included by ACER among the list of their best practices. So I would like, among many practices, I would like to mention specifically 2 points. First, when allocating new capacities at LNG terminals, we think that in any process of allocation, it is very important that new capacity, that in case of allocation of new capacity, the facility strikes a balance between long and short-term products. So concretely, we have seen cases in which at least 10% of the annual capacity for short-term allocation has been withheld, so separated and reserved for short-term products. This is very helpful. It's true, we understand it's true that it exposes the decision of investment to additional market risk, but it's also true that market risk has a possibility of upside, of course. And we think that reserving part of the capacity for short term will not increase the risk of an LNG terminal to become a stranded asset, due to the effect that the demand for short-term products by the LNG market is very strong, keeps to be very strong, and we expect that it will still keep being very strong. Why this? Specifically because short-term allocation makes terminals more attractive, because it provides market participants of flexibility to respond to changing market conditions and to take advantage of price differentials. And this flexibility improves, in general, security of supply, because it allows imports, cargoes to be sent to Europe quickly, increase quickly under price tensions, and it's critical to intercept the cargoes that otherwise could go elsewhere. And while, for example, long-term capacity does not always correspond to continuous long-term delivery of cargoes. So these are the main points for this. A second point that I would like to highlight is how to use efficiently, especially when it comes to managing congestions. It is important, of course, for users to confirm the intent to use the slot. It is important as well that facilities disclose and allocate unused slots before delivery, of course, for the reasons of maximizing capacity usage and preventing capacity hoarding. From our point of view, practically, concretely, from our experience in the market, we see that this relocation of slots, it's rarely a market opportunity, because market conditions are very similar for all the participants. But still, it's a good instrument to have available. In some cases, we've seen 30 days of prior to usage confirmation to use the slot, which is very, very prudent. Shorter periods are also possible, definitely, and this wouldn't make the instrument less useful for the market. We need, but very important, is to make sure that we ensure flexible use of book capacity. Existing customers should be able to transfer part or all the capacity at the terminal in the most flexible way possible. Finally, 2 points. It's true, as it was mentioned in the ACER report, the transparency has improved a lot. We think that it makes sense to focus some additional efforts in this sense. We have seen in some cases facilities publishing annual reports for non-allocated capacities and the reason for these capacities not to be allocated. This helps the market to have this information. And finally, a very, very important point is the fact that the facilities give the users the possibility to shape the sendout. This was mentioned also in ACER report. It's very important. It gives the possibility to operators to adapt to market circumstances. So this is a very, very important point. Thank you. That's all from my side.
Many thanks, Simone. Very interesting insights from a technical and real life perspective. At this point, I'm turning to Alex, and not only that we thank you for your presentation, but we would like to dig more into detail into what we anticipate in terms of LNG outlook. And your question would be, how do you anticipate the trajectory of the global LNG demand and supply dynamics? And then we would like that you kind of take us a little bit that we to the end of the decade, and then what would you foresee by the end of the decade, how the EU would be positioned compared to the Asian markets, and what you find important there in terms of outlook and in terms of how EU could prepare better.
Yeah, thank you. So quite a big topic there. But when we look at the short term, the summer, we're looking fairly comfortable. As we go to next winter, there's potentially some risk if it was very cold. That's partly because this year, last year, we haven't had a lot of new production coming into the market. So there's been increased demand to replace lost pipeline gas or demand from Asia, but there hasn't been a lot of new supply. That's going to change from next year, though. That's the new world that we're going to enter over the next couple of years and for the rest of the 2020s, which should make the market more comfortable going through to the end of the decade. First of all, we have a big new wave of US supply projects starting up. Some of those will either start to come on this year, then a lot more next year. So we're looking at projects such as the Corpus Christi expansion, Plaquemine, Golden Pass, LNG Canada. There's a lot of projects both in the US, Canada, Mexico. So that's really going to add a big new wave of supply. And it's been a few years since we've had sort of one of these big supply waves of expansion. Plaquemine, the Venture Global project, I believe that they've issued a statement last week saying that they may begin producing LNG in the middle of 2024. So, you know, there could be some initial early cargoes, not full production, but some initial cargoes in the second half of this year. We have BP's Tortue project off Senegal in West Africa by the end of the year. And then there's other ones that we mentioned. Then as we come into 2026, 2027, we have Qatar's huge expansion. Qatar for many years was the biggest LNG producer in the world at 77 million tons a year. Then Australia and the US, they rose up, they matched Qatar. The US has currently overtaken Qatar as the biggest producer in the world, but Qatar is going to almost double by the end of the decade, from 77 million tons to, they've now told us, 142 million tons per year. And I don't think that's all sold yet in long-term contracts even, so there's some of those volumes potentially available for longer-term contracts for buyers. So, you know, a more comfortable market as we get all these extra supplies coming in. The LNG market should grow. I think we heard earlier in the ACER presentation, this is also, I know it's in Shell's LNG outlook. The market could grow from 400 million tons now to around 600 million tons by the end of the decade. So that's a 50% increase in the LNG market. So that's a huge increase in LNG supply. But beyond 2030, as we go further along, there's quite a bit of uncertainty, you know, because we have so much competition between renewables and nuclear, and do we have green hydrogen and all these other sort of options as well. A lot of the growth in demand is probably going to come from Asia as we grow that market. Europe, if Europe wants those cargoes, it can pay a higher price and compete for them. If Europe pushes ahead with the plans, the policies that we've heard, and is looking at renewables and other options, then its demand will be lower. But as we get to 2030, 40, 50, obviously there's a lot more uncertainty on how policies will play out and exactly what the growth or the decline rates of demand will be.
Thank you very much. It's a very good sort of summary about looking more near term and further long term. And of course, we see that the elements of decarbonization will then play a role. And then we have to see how we would sort of utilize the LNG, either from SOS perspective or any other perspectives in terms of flexibility and having flexibility in a decarbonized market. At this point, we are hitting the question and answer time at this webinar. And I would like to ask the first question to Joaquin about how we see if we kind of look into the analysis and further than what we have done in our report. The question is, what would be the dominant indexation in spot EU LNG trades, and has also ACER analyzed the indexation of long-term EU LNG contracts? Joaquin, the floor is yours. Try to keep it short.
Yeah, very rapidly to cover more questions. I think Pedro, for the spot LNG dominant indexation, Pedro has shown that in the slide. Is clearly TTF on the lead. For the long-term contracts, we have also analyzed those data. Also banking, as I was referring at the beginning, on this LNG price assessment that provides very rich information. And here what we are seeing is a different trend. Clearly for those long-term contracts signed with US producers, Henry Hub is more dominant. But also with other producers, what we are starting to see is a callback to some Brent indexations and a slight decline on TTF indexations. We could attribute this slight decline of TTF perhaps to the rising volatility in the last couple of years. This could be a possibility, but this is what we are observing in short. Thanks.
Thank you very much. The next question goes to Pedro, and the question is about has the European Union overinvested in LNG regasification capacity, considering the future decline in gas demand, or also the decarbonization targets? And we have another connecting question to repower and Fit for 55. But I think this is the broader question. So Pedro, try to come in and address somehow both.
Thank you. So I think talking about overinvestment in regas capacity can be misleading if you look at the global average in the European Union, or you look at the annual utilization rates, because in some countries like Spain and France, this regasification capacity was designed to reach the daily peak demand in winter, because the withdrawal capacity in underground storages is not able to do that. Beyond that, 75% of new regasification capacity comes from FSRU, so that can be easily repurposed or relocated to other markets outside the European Union. But the additions of new capacity is very relevant, and this needs to be analyzed on a country basis, because as we saw before in a previous slide, where we saw the congested capacity in Netherlands and Germany and the different spreads over time, new capacity helps to alleviate congestions and reduce price spreads, and this is very relevant in different regions, like in the Baltics, and also with the reconfiguration of flows in Central and Eastern Europe after Ukraine transit contract of Russian supply will expire, will be more relevant that the cross-border flows from LNG regasified will reach Central and Eastern gas markets. On the decarbonization scenarios, too ambitious or not realistic, in terms of gas demand in the European Union, we have already decreased by 50 BCM since 2021. This is quite a very relevant number. And this is mainly due to the faster rollout of wind and solar, which is already reducing natural gas consumption in gas-fired power plants. So last year, wind and solar added 84 terawatt hours more generation than the previous year. Also, the deployment of heat pumps and isolation improvement in buildings is going to reduce gas demand for space heating, but also electrification and energy efficiency will offset gas in the industrial sector. So I think this is already taking place, and probably the pace of we reach these targets is what is more uncertain, but this is already taking place.
And maybe a quick final question about again the report and its estimation. What is our definition for long-term LNG contracts for delivery into Europe? And the person asking this question believes that we have higher estimates. How do you see that, Pedro or Joaquin? And Alex, feel free also to come in if you have a specific view on long-term contracts, but very briefly, of course.
Okay, yes, to set the contracted level of the European Union, we've been looking into the contracts that will be active in this decade. So the contracts that will be expiring are not accounted, but also the contract that in the future will be active only from those projects that are under construction. And on top of that, we only include those contracts that have indicated EU as intended destination. So we are not including contracts in hands of portfolio players that may be delivered anywhere. So this is how it was done.
Other views about long-term contracts? And if not, Alex, if you want to say a few words, just one sentence too. Thank you.
Yes. Well, what we hear in the market really is the difficulty is around the traditional long-term contract was 20 years. If you're building a new plant and you want a 20-year contract, you might start building the new plant in 2030. 20 years takes you up till 2050 when we have important decarbonisation targets. So the difficulty is that a lot of the buyers would like a shorter term 10 or 15-year contract, and the producers want 20-year deals to support their new plants. So there's a bit of a tension there around getting the two sides to agree or work together, and just making sure that the supply and demand will balance over the coming decades.
Just to follow up, there has been 27 years term contract signed provided by Qatar, and those contracts with major European off-takers have been publicly announced as flexible. So this is an important feature to bear in mind.
Thank you very much. Thank you very much for all these contributions and the questions, and for the active participation of those who are listening us today. We will respond the unanswered questions in the Slido. So please bear with us and pick up the answers from the Slido. And at this point, I would like to conclude the webinar. We were very grateful to get this high attention for this new MMR volume that we were publishing on the 19th of this month. And then we see that also the webinar showed a great interest in this topic. What we are committed to do going forward, that we will keep monitoring the LNG markets. In the future editions, we will focus more on the pricing aspects, also the cyclicality of the markets, outlooks, price setting, contracting in terms of long-term and spot. But we will also look into the flexibility and how the infrastructure is utilized. We are keenly interested in transparency aspect, but also on competition, market access, the utilization of market-based methods, and as well we would be looking also in some of the questions that Simone was raising about optimization and flexible utilization, both in terms of products, but also in terms of send-outs and how the terminals are utilized. And with that, I would like to thank you very much for participating, and I'm closing the webinar. Goodbye and have a very good day.
Thank you.
Thanks a lot. Bye.
Goodbye.
Goodbye.
Bye.